Welcome to this comprehensive summary of Buy Then Build: How Acquisition Entrepreneurs Outsmart the Startup Game by Walker Deibel. This book presents a revolutionary approach to entrepreneurship, one that sidesteps the brutal startup phase entirely by acquiring existing, profitable businesses instead of building from scratch. Walker Deibel isn't just a theorist. He's acquired 7 companies and co-founded 3 startups over the past decade. Through both success and failure, he's learned that there's a smarter, faster, and less risky path to becoming a CEO of your own company. That path is acquisition entrepreneurship. The traditional startup story celebrates heroic founders grinding through years of uncertainty, burning through capital, and beating impossible odds. But here's the reality: 90% of startups fail. Even venture capital-backed startups have a 75% failure rate. The entrepreneurial dream too often becomes a nightmare of lost time, money, and opportunity. But what if you could start on day one as CEO of a profitable, established company? One with customers, revenue, employees, and a proven track record. What if you could skip the startup phase entirely and focus immediately on growth and value creation? That's the promise of acquisition entrepreneurship, and over the next hour, we'll explore exactly how to make it happen. Part 1. The Opportunity. The Startup Flaw. Let's begin with a story. Walker's startup, Viewpoint, had everything going for it. The CEO was a former Microsoft executive. The largest investor was a Fortune 500 CEO. The development team had built successful enterprise software before. They graduated from a top 10 accelerator program and had beta trials inside recognizable companies. They were oversubscribed in their equity raise. And they failed completely. This wasn't Walker's first startup failure either. Despite learning from previous mistakes, despite having an all-star team, despite doing everything right, Viewpoint ran out of cash with no functional product and no paying customers. The harsh truth? Startups have an inherent flaw: they mostly fail. Even if startups survive, most never amount to much. Only 4% of all companies in the United States ever exceed $1 million in revenue. When you do the math, well over 99% of all startups either fail completely or never really scale beyond supporting their founders. The acquisition alternative. After Viewpoint collapsed, an advisor showed Walker a printing and distribution company generating a few million in revenue. Despite his previous failures, Walker saw something different: an opportunity to acquire established infrastructure with paying customers and proven revenue. He acquired the company in early 2015 with a low 6-figure investment and a bank loan. Within 11 months, his team more than doubled the marketable value of the company by bringing innovation to an established, stable business. They created a proprietary e-commerce platform using the company's cash flow, something they couldn't achieve at Viewpoint despite millions in venture capital. The following year, he acquired another complementary business, merging it in for a 20% revenue boost and 500 additional customers, again funded by the cash flow of the business he'd already acquired. This is the power of acquisition entrepreneurship, combining the stability of an existing business with the innovation and drive of an entrepreneur. You get customers, revenue, employees, brand awareness, and most importantly, cash flow from day one. The $10 trillion tsunami. Here's where the opportunity gets extraordinary. Baby boomers own 12 million small businesses, 43% of all small businesses in America. Starting in 2013, they began retiring at 9,000 per day. By 2021, that rate increased to 11,000 per day. Between 2013 and 2029, approximately $10 trillion in existing business value will need to change hands. This massive supply increase is creating a buyer's market like we've never seen. The infrastructure built by previous generations is becoming available for purchase at the most affordable levels in history. Most people simply don't understand that you can buy a substantial, scalable existing business for under $100,000 down. Combine this with the retiring baby boomer population, and we have a once-in-history opportunity for acquisition entrepreneurship to thrive. Why acquisition is more affordable than you think. Let's talk numbers. The average startup in the U.S. launches with $65,000 in invested capital. The average down payment on a home is approximately $57,000. Whether starting a business from scratch or buying a house, people are investing around $65,000. But here's the difference. With acquisition entrepreneurship, that same $65,000, paired with a 90% SBA-backed loan, could buy a company generating over $1 million in revenue. You'd immediately become CEO of a company in the largest 4% of companies in the United States. Here's loose math on how this works. $65,000 invested plus a 90% SBA loan equals a $650,000 purchase price. A company this size typically sells for about 3 times its adjusted earnings, meaning it's generating roughly $216,000 in annual discretionary earnings. Assuming a 15% profit margin, this company generates over $1.4 million in revenue. Banks will lend on business acquisitions because they use the assets of the business as collateral. You're not asking for an unsecured personal loan, you're financing a revenue-generating asset with proven cash flow. Part 2. Evaluation, the CEO mindset. Starting with yourself. Most people start looking for a company to acquire completely wrong. They begin by thinking about what industry interests them. But successful acquisition entrepreneurs turn this upside down. They start by aligning their attitude, aptitude, and action, what Walker calls the law of 3 As. Attitude, the growth mindset. Stanford psychologist Carol Dweck has spent decades researching what separates successful people from those who plateau. Her answer? A growth mindset. People with a fixed mindset believe their qualities are carved in stone. They need to constantly prove themselves and worry about looking smart. They avoid challenges, give up easily when facing setbacks, see effort as fruitless, ignore useful criticism, and feel threatened by others' success. People with a growth mindset believe talents can be developed through hard work, good strategies, and input from others. They embrace challenges, persist through obstacles, see effort as the path to mastery, learn from criticism, and find inspiration in others' success. The growth mindset is arguably the #1 predictor of entrepreneurial success. It allows you to learn from mistakes, adapt to changing circumstances, and persist through the inevitable challenges of business ownership. Without it, even the best opportunity will flounder. The good news? If you don't currently have a dominant growth mindset, it can be cultivated. The first step is identifying when your thoughts take on a fixed framework, particularly during times of challenge, setback, or criticism. Learn to recognize your fixed mindset voice, then consciously respond with growth-oriented thoughts. Aptitude, your skills and strengths. Aptitude combines raw intelligence with competencies, your skill sets, strengths, and weaknesses. Research shows high intellectual ability combined with drive to succeed is essential for entrepreneurial success. But IQ isn't everything. Emotional intelligence increasingly rivals traditional intelligence in predicting performance. The competencies that most strongly correlate with successful CEOs include strategic thinking skills and the ability to deal with ambiguity, interpersonal skills and the ability to sell, tenacity and perseverance, being achievement-oriented and optimistic, creativity applied to problem-solving, appropriate levels of self-confidence, not cockiness, moderate risk tolerance, calculated, not reckless. Interestingly, being organized, methodical, or laser-focused shows no correlation with CEO success. Business requires managing ambiguity and changing landscapes. Perfectionism is actually a negative. In entrepreneurship, action is rewarded over perfection. You need to assess yourself honestly. Create a personal SWOT analysis: strengths, weaknesses, opportunities, and threats. Put together your resume, highlighting quantifiable accomplishments. Get feedback from your spouse or close friends about your strengths and blind spots. Action: what you'll actually do. Imagine your perfect workday as a CEO. What are you doing with your time? What activities make you lose track of time? This is your right action, understanding what you want your daily life to look like. Most business activities divide into two categories: revenue generation and operational execution. Are you oriented toward growing the top line through sales and marketing? Or do you prefer operational excellence, making things run smoothly and efficiently? You don't need to be exceptional at both, but you need to know which drives you. The acquisition you target should align with your natural orientation and provide opportunities to apply your strengths. Be specific. Do you enjoy talking on the phone all day or managing emails? Running production meetings or going on sales calls? Managing online marketing campaigns or integrating new systems? Coordinating people's activities or digging into metrics? Your answers to these questions will guide your search. The company you acquire should not only provide a financial opportunity, it should align with how you want to spend your days. The three as working together. When you align attitude, aptitude, and action, you create a powerful foundation for success. You know you have the right mindset to handle challenges. You understand your strengths and where you'll need help. You know what activities energize you and which drain you. This self-knowledge becomes your compass. It prevents you from chasing shiny objects or settling for a business that looks good on paper but doesn't fit who you are. Without this alignment, you'll join the 90% of would-be buyers who start searching but never close a deal. Part 3. Defining your target. Opportunity profiles. Walker identifies 4 main acquisition opportunity profiles, mapped on a matrix of growth versus value. Eternally profitable. These are cash cows in mature markets serving needs unlikely to disappear. Think snow removal, plumbing, or preschools. They offer stability and dependable returns but limited growth. The value is in consistent, predictable cash flow with minimal disruption risk. Turnaround. These are businesses that have fallen on hard times. You're acquiring undervalued assets and applying operational excellence to fix problems. It requires strong operational skills and financial acumen. The risk is high, but so is the potential for value creation if you can execute. High growth. These companies are already experiencing significant revenue increases. They're exciting but come with risks. You'll pay a higher multiple for past performance. If growth doesn't continue, you've overpaid. If growth accelerates, you'll need additional working capital. These businesses typically have tight cash flow despite strong revenue. Platform. This is Walker's preferred approach. You're acquiring a stable business that provides a platform for executing your specific growth opportunity. The business matches your skill set. Maybe it needs B2B sales and that's your strength, or it lacks online marketing but has great products. The platform model focuses on matching the specific growth opportunity to your abilities. You're not just buying any good business, you're buying the right business for you to make great. Defining size by cash flow, not revenue. Most people think about business size in terms of revenue. This is wrong. What you're buying is cash flow, the ability of the business to generate profit. Define your target by seller's discretionary earnings, SDE, the total cash benefit to the owner, including salary, benefits, and all discretionary expenses. This is what the business actually produces for its owner. A company with 70% margins looks very different from one with 1% margins, even at the same revenue. Define your search by the SDE range you can afford based on your available capital and financing. Here's how to calculate what you can afford. Take your available cash for investment, X, divide by 10% to get purchase price at 90% leverage. Divide purchase price by typical multiple, usually 2.5-4x, to get target SDE. This gives you your target cash flow range. For example, $100,000 cash divided by 0.10 equals $1 million purchase price divided by 3.2 multiple equals $312,500 target SDE. This company likely generates $1.5 to $3 million in revenue depending on margins. Industry type, not specific industry. Don't limit yourself to one specific industry unless you have truly valuable relationships or credentials, like being a dentist buying a dental practice. Instead, define by industry type. Product companies, manufacturing or brand ownership. Distribution companies, logistics, inventory management, channel management. Service companies, professional services, consulting, retail, custom manufacturing. Defining broadly keeps more opportunities available while still providing focus to your search. Your target statement. Pull this all together into a clear target statement. I am looking for a product/distribution/service company with type of growth opportunity, generating $X to $Y in SDE, with any geographic or other limiters. Example, I'm looking for a manufacturing company with no current e-commerce presence, generating $250,000 to $300,000 in SDE. This statement becomes your compass. It focuses your search while remaining flexible enough to capture real opportunities. More importantly, it communicates clearly to brokers and advisors exactly what you're seeking. Part 4. The search process. Skip the internet listings. Most people start by browsing BizBuySell or similar listing sites. Don't do this, at least not as your primary strategy. Your company is very likely not on these websites. These sites contain 3 types of businesses: junk, non-growth businesses, laundromats, car washes, or good businesses that will sell quickly. The good listings disappear fast, leaving everything else sitting there, creating the illusion of a poor market. More importantly, you need to get upstream. Brokers put listings online only after reaching out to their vetted buyers and professional networks. If you want first look at the best opportunities, you need to be in that network before listings hit the internet. Broker outreach, getting upstream. Search for business brokers, intermediaries, and investment bankers in your area. Make a list with contact information. You're going to meet with all of them. When meeting brokers, they want to know 3 things. How you present yourself. Are you professional and prepared? Show up on time, dress appropriately, follow up with thank you emails. Bring your personal balance sheet and resume. Do you have the money? Can you actually close a deal? Brokers spend months working with buyers who can't execute. Show you have capital or committed backers. Discuss how you'll obtain bank financing using the business assets as collateral. What are you looking for? This is where your target statement shines. Instead of vaguely describing an industry, you clearly articulate the specific opportunity profile, SDE range, and parameters you've defined. By demonstrating you're a prepared, serious buyer with clear objectives and the means to close, you immediately differentiate yourself from 90% of potential buyers. Building your network. Ask each broker for recommendations. Other brokers, CPAs, lawyers, bankers who specialize in business transactions. Every meeting should generate at least 2 to 3 new contacts. Ask brokers if they know business owners considering selling. CPAs and lawyers often know clients exploring exit options. Bankers work with many small businesses and might know sellers. You're not just looking for listings, you're building a network of deal flow. The best opportunities often come through relationships before ever being formally listed. Direct outreach. Every business is for sale. Don't wait for perfect listings. Identify companies you'd like to own and reach out directly. Most owners will have a conversation. They're either ready to talk now or will be ready later. Your strategy can be: reach out directly and start a conversation. If they're interested, introduce a broker to help with valuation. If they like the valuation, move forward together. Or recruit a broker to reach out for you, explaining they have a specific buyer interested in their company. This professional approach often works better than cold outreach. Private equity firms do this constantly through mailings and email campaigns. The willing buyer at the table is usually the path of least resistance for the seller. Banker outreach. Prepare for financing. Simultaneously with broker outreach, start meeting with banks. Not all banks are created equal for business acquisition loans. Network to find banks experienced in SBA lending. Every community has a list of banks issuing the most SBA loans. Start there. Look for SBA preferred lenders who can approve loans in-house, saving 6+ weeks in processing. When meeting bankers, present who you are and your business experience. Share your target statement. Ask about their experience with acquisition lending. Ask for referrals to brokers and other potential buyers. Banks will want to know if you qualify personally. Bring your personal balance sheet, 3 years of tax returns, and be prepared to discuss your credit history. Don't ask for money yet. You don't have a deal. But build relationships so when you do have an opportunity, you can move quickly. Having 3 to 4 banks competing for your business when closing time comes will get you the best interest rate. The secret: loan-to-deposit ratios. Here's insider information. Whether a bank is actively lending depends largely on their internal loan-to-deposit ratio, a metric they don't publicize. Sustainable banks run 60 to 70%. Growth-oriented banks want 90% plus. Finding hungry banks with good opportunities in hand means faster funding and better terms. This is why you build relationships with multiple banks. The right bank today might not be available in 4 months when you need them. Your professional team. Beyond bankers and brokers, you need CPAs. Find accountants experienced in business transactions, not just tax preparation. They should have worked on both buy and sell sides. They'll be critical in due diligence, helping you understand the financials and identify red flags. Lawyers. Time and again, lawyers are deal breakers, not deal makers. Their job is to protect you at all costs, even if it means killing the deal. You must manage them carefully. Use lawyers who specialize in business transactions and understand your goal is to close a fair deal, not extract perfect protection on every point. Negotiate not to exceed budgets with both CPAs and lawyers. Request invoicing after closing so you can treat it as a business expense for tax benefits. Part 5. Making an offer. The first meeting. Selling yourself as the buyer. When you find an interesting opportunity and request the offering memorandum, you'll typically have a call with the broker first, then meet the seller. Most buyers approach this wrong. They go in skeptical, reserved, looking for reasons not to buy. They expect to be pitched and act like conservative investors who need convincing. Flip this completely. Your first job is to convince the seller you are absolutely the right buyer. Only then do you determine if the company is right for you. Approach the seller meeting like a job interview where you're interviewing to be CEO. Be prepared to thank them for meeting with you. Give your background and relevant accomplishments. Explain you're actively searching with a defined process. Share that you've arranged access to capital and are committed to buying within a defined time frame. Complement the business by highlighting what interests you. This immediately comforts the seller. They see you like their business, are prepared and structured, and can actually close. You've just become their favorite potential buyer. Downloading the seller's brain. Your objective in seller meetings is to learn the business inside and out. Ask the same questions multiple ways at different times. You'll get more complete answers and identify smoke screens where they give canned responses. Move around in your questioning. Don't follow predictable patterns. If discussing customer concentration, suddenly switch to inventory management, then circle back later. This gets more honest answers because they're not anticipating your next question. Key areas to explore. Genesis and evolution of the business. What makes them different? Value proposition, customer makeup and concentration. Competition and competitive advantages. Growth opportunities. Biggest challenges and threats. Why they're selling. Save this question for late in the conversation. Ideal buyer profile. Key personnel. What they'd change if they were buying it. Tour the facility. Observe cleanliness, organization, employee focus, asset condition. The culture is visible. Does it feel energized or lethargic? Are employees engaged or checked out? The letter of intent. When you're ready to make an offer, you submit a letter of intent, LOI. This non-binding document outlines type of purchase, asset sale, preferred, or stock sale. Purchase consideration, your offer price and structure. Closing date, typically 30 to 90 days out. Contingencies, financing, due diligence, inspections, etc. Asset purchase agreement, agreement to sign binding documents later. Escrow deposit, good faith money held by broker. Expenses, who pays for what. Confidentiality and exclusivity, binding requirement that seller works only with you during due diligence period. Structuring your offer. Base your valuation on the business's ability to afford itself. Calculate the debt service on your proposed loan. Subtract that from the seller's discretionary earnings. What remains should comfortably cover management costs and provide return on your investment. Stress test your model. How much could revenue decline before you're in trouble? If SDE is $400,000 and debt service is $170,000 annually, you need $250,000 minimum to survive, including management salary. That's a 37% revenue decline buffer. Are you comfortable with that risk? Typical deal structures. All cash. Seller walks with 100% at closing. Used for competitive situations or when you have high confidence in the business. Seller note. Seller finances 10 to 20% of purchase, paid over 2 to 5 years. This keeps seller invested in the business's success and can reduce or eliminate your required down payment. Earn-out. Future payments based on performance. Used when there's material risk or reward on the horizon, declining business, high customer concentration, large contract renewal pending. The negotiation dance. An initial LOI is rarely accepted as is unless you offered asking price or better. Expect counteroffers. Look for where you've agreed. Those are wins. Understand the seller's psychology. Do they want more cash up front, higher price, faster closing? The art of negotiation is identifying what's critical to them but not to you, and vice versa. Give on points that don't matter to you but matter to them. Get something in return when you give on points that do matter. Negotiate everything you can accept price before making your final offer. This reveals what's truly important to the seller beyond price. Future employment of key people, timing, real estate considerations, their reputation and legacy. Remember, you don't have to buy anything. If you feel you're being lied to or taken advantage of, walk away. But if you trust the seller and want the business, your goal is a fair deal where both parties get what they need. Part 6. Due diligence and closing, 10 minutes, the acquisition phase. Once an LOI is signed, multiple things happen simultaneously. The purchase agreement must be constructed, negotiated, and signed. You form your legal entity. You secure committed financing from your bank. The seller removes contingencies, lease, appraisals, permits, etc. You conduct thorough due diligence. The purchase price is allocated across asset categories. This phase is complex because of the communication channels involved. You're talking with the seller, broker, your lawyer, your accountant, your banker, and potentially investors. The seller has their lawyer and accountant. Lawyers might talk to each other. That's 8+ people with 28+ communication channels. Each person has different financial incentives. You want to buy, probably this company, but maybe not. Seller wants to sell under certain conditions. Broker wants to close the transaction. Banker wants to make a good loan. Your CPA wants to help you but wave red flags. Lawyers want to protect their clients at all costs, even if it kills the deal. Over-communicate at every step. Keep the goal in mind. Be sensitive to everyone's objectives but stay true to your position. The deal will likely fall apart at least once during this phase. It's normal. The broker should keep things moving because they know time kills all deals. Due diligence. Verify everything. Due diligence falls into 3 categories. Legal due diligence. Verify the entity is legal and the seller has the right to sell. Review certificates of incorporation, operating agreements, bylaws, partnership agreements, licensing, permits, supplier contracts, customer contracts, intellectual property rights, insurance contracts. Are there current or pending legal issues? Financial due diligence. Validate everything you've received is correct. Request internal statements, tax returns, monthly bank statements for 3 years, general ledgers, depreciation schedules, payroll records, updated statements from major suppliers, and detailed lists of all equipment, inventory, and office supplies. Calculate working capital requirements multiple ways. Current assets minus current liabilities, 3 months operating expenses, or cash conversion cycle analysis. Understand how long cash is tied up in the business. Operational due diligence. Follow an order through the building from start to finish. Understand internal systems, who's trained, who's key, where files are kept. Perform random checks on customer orders and costs. Review sales and marketing processes. What's working? What's not? Did the owner cut marketing to boost earnings before selling? Running down rabbit holes. Every question leads to more questions. This is normal. Get organized. Use a project plan or detailed to-do list. Every concern must be addressed satisfactorily. Don't just look for reasons not to buy. You're also validating that this is a good business you can make great. Understand the business drivers. What's the one metric that drives revenue? How can you accelerate it? Use this time to build relationships with potential customers in your network. You don't own the business yet, so you have zero sales pressure. People will openly share what they value, what they'd pay for, who the competitors are. This intelligence is gold, and you can only gather it risk-free before closing. The 11th hour freak out. As closing approaches, almost every buyer experiences heightened concern. You're seeing how the sausage is made, and the initial allure wears off. Skeptics on your team, lawyers, accountants, spouse, emphasize risks. New concerns emerge. This is completely normal. Call your broker and work through concerns. Most are manageable. The prep work you did, aligning the 3 As, defining your target statement, conducting thorough due diligence, should give you confidence. You still don't know what you don't know. That's true of every entrepreneur. Despite the unknown, we take calculated risks and create the future we want to see. Closing day. A few days before closing, all documents should be completed and reviewed. The day before closing, finalize inventory counts and accounts receivable/payable amounts. These impact the final transaction price. Closing involves a 12-inch stack of paperwork if using an SBA loan. You'll sign lease agreement, lien filings, promissory notes, non-compete agreement, bill of sale, and many more documents. Ensure you get proper access to all IP, code, passwords, and virtual storage. Closing can take all day. Often you'll formally meet employees the day after closing rather than the day of. Part 7. The first 90 days. Day 1. The all-hands meeting. Your first act as CEO is announcing the acquisition to all employees. The seller typically speaks first, confirming the news and introducing you. This is their last time addressing the team they built. When you speak, keep it simple and truthful. Employees have 2 main concerns. Will there be layoffs? Will salary or benefits change? If possible, immediately communicate that everyone will be hired and nothing will change with benefits, at least for the first 90 to 120 days. Let them know you bought the company because of what it's already doing, and everyone played a part in that success. Open the floor to questions. The most common: how do you plan to grow the company? Be conservative in your answer, underpromise and overdeliver. Share your initial observations about growth opportunities and convey that each person will play a role. The first month, focus on people. Spend the first 30 days learning about the people who make up the organization. In the first 10 days, have a short one-on-one meeting with everyone. Start with management and work through the organization. Ask each person what they do in the organization, their background, who they interact with. Observations for improvement. What would you focus on if you were in my shoes? The goal is making every employee feel heard and knowing you're accessible. You'll quickly learn who the top performers are, where alliances exist, who shows up early, and who gossips. Meet your largest customers. Ask how long they've been buying from you, why they choose your company's strengths and weaknesses, where you could improve. What one thing would be most valuable? What would cause them to leave? Schedule quarterly check-ins with key customers to review performance and explore opportunities. Meet key suppliers. Make clear what you need from them and how you'll evaluate their performance. Go around the sales rep to meet the president directly. You'll need that relationship if performance ever falters. The seller will be present during this first month for training, but get them out as soon as possible, but not a moment earlier. Once the deal closes, employees align with you immediately, and the seller is mentally ready to move on. You'll find you don't really need them after the first few weeks beyond occasional phone calls. The second month, learn the systems. Focus on deeper learning of all systems and processes. How do people work together? What should the metrics be? Where are easy optimizations? Follow orders through the company from sale to delivery to invoicing. Learn the accounting system and order entry system intimately. Smaller companies rely more on people than processes. Identify your bus test people, those whose loss would cripple the company. Begin documenting their job processes. This starts your path to improvement, having documented processes rather than depending on specific people. Financial things will be messy. AP and AR may not line up perfectly. Checks might get deposited to wrong accounts. Get a handle on cash flow immediately. Put together a 13-week cash flow projection to understand your cash demands. Consider best practices in the industry. Establish ongoing meetings with supervisors. Make sure you can effectively perform all your adopted responsibilities. Write an implementation plan for the future. Define goals and objectives. Metrics for success. Scheduled milestones. Allocation of resources. Team responsibilities. Create a dashboard or balanced scorecard to track progress on metrics that matter. Don't make any significant changes yet. You're still learning all the moving parts and how your actions ripple through the organization. The third month, implementation. 60 to 90 days after taking ownership is when most would begin making changes. You now understand the people and processes deeply enough to know how your actions will impact the company. Form your short and long-term goals. Solidify the plan you developed before acquisition. Create your vision and communicate it to employees. Begin implementing your growth initiatives. This is your time to shine. Launch your growth initiatives, get buy-in from your team and key customers, then dig in and start making substantial progress. Over time, you'll build momentum and the future you're building will come into focus. Part 8. Growth through acquisition: the revelation. Here's a powerful insight. When sales reps leave companies, only about 13% of customers feel that sales rep understood their needs. 91% of customers say they'd give referrals if asked. This suggests the value comes from the product or service, not the sales rep. When reps leave, they usually try to take customers with them to their new company. But in reality, customers almost always stay with the company, not the rep. The value proposition is what they're buying, not the relationship. So instead of hiring new sales reps and hoping they bring business, what if you acquired a competitor outright, taking over their customers, brand, and sales reps simultaneously? If you're trying to hire reps who can each generate $1 million in new revenue, and you could afford 3 to 5 reps, that's $3 to $5 million in new revenue you're targeting. A competitor generating $4 million in revenue could be acquired with a minimum down payment around $180,000, about what you might pay to hire one great rep, with none of the hiring risk or training period. Growing through acquisition. There are 3 ways to grow any company. Get more customers. Increase order frequency from existing customers. Increase average order value per customer. Growing through acquisition can accomplish all 3 simultaneously while also adding infrastructure and capabilities affordably, capitalizing on industry trends, expanding geographically, acquiring talent and expertise, achieving economies of scale. When you acquire infrastructure instead of building it, you pay a multiple of cash flow using debt vehicles. When you build infrastructure, you need invested capital for the build-out. Acquisition is often faster and more affordable than organic growth. Walker's own experience illustrates this. He wanted to expand into digital printing, but the infrastructure cost was intimidating. By acquiring a company that already had the digital infrastructure in place, he got a profitable revenue-generating platform for a fraction of what building would have cost. The cash flow from his existing business covered the acquisition debt and reinvestment. He accelerated the strength and reach of his company while maintaining a margin of safety that new hires and product development lack. Acquisition as exit strategy. Here's an interesting twist. When Walker was searching to grow through acquisition, he approached a company that was perfect for his needs. After months of discussion, the CEO of that company said, "We absolutely have to do this. I just want to change one thing. I want to buy you." Trying to grow through acquisition is also an excellent way to exit a company. It positions you as a strategic asset to larger players in your industry who are looking to expand. This is precisely how most successful exits occur, not through IPOs or venture capital windfalls, but through strategic acquisitions by companies looking to grow. Conclusion: The Entrepreneur's Economy, 5 minutes, The Fourth Economy. Ron Davison's book The Fourth Economy traces economic development through agricultural, industrial, and knowledge periods. Each transition occurred when investments in the previous driver showed diminishing returns. Land drove the agricultural period. Access to capital drove the industrial period. Education drove the knowledge period. But since 2000, with land accessible, capital abundant, and education saturation unable to produce higher pay rates, a new limiter has emerged. That limiter is entrepreneurship itself. Right now, says Davison, becoming an entrepreneur is like becoming a knowledge worker in 1900. That is, it's possible but hard enough that few people do it. Entrepreneurship is the key to success in the current economy. And we're living through a unique historical convergence. Entrepreneurship defining the economic frontier at the exact moment when $10 trillion in baby boomer business value needs to change hands. The end of jobs. As Taylor Pearson documents in The End of Jobs, traditional employment is becoming less available. Since 2000, population has grown 240% faster than job growth. The question is no longer, how do I get a job doing that? It's how do I create a job doing that? Entrepreneurship isn't just popular anymore, it's necessary. Creating opportunity and building value are essential skill sets for thriving in the new economy. Acquisition entrepreneurship provides a career accelerator for people going out on their own. It provides infrastructure beyond just one person. Instead of the brutal statistics of startup failure, you begin with a proven, profitable platform. Why this matters now. We've covered the why, the what, and the how of acquisition entrepreneurship. Let's recap the compelling case. The startup model is broken for most entrepreneurs. Over 99% of startups either fail completely or never scale beyond supporting their founders. Even with venture capital backing, 75% fail. The startup phase is a company killer. Existing businesses offer inherent advantages. They have customers, revenue, employees, brand awareness, and proven product-market fit. They provide a profit-generating infrastructure from day one. You skip the startup runway entirely and focus immediately on growth and value creation. The economics are compelling. With the same capital required to launch a startup, around $65,000, you can acquire a company generating over $1 million in revenue using bank financing. You own 100% of the company instead of diluting through equity investors. The return on investment can exceed 100 to 250% annually. The opportunity is unprecedented. Baby boomers retiring at $11,000 per day need to sell 12 million businesses over the next decade. This $10 trillion transfer of business value creates a once-in-history buyer's market. Infrastructure built by previous generations is available at the most affordable levels ever. The path is clear. You now know the process. Align your attitude, aptitude, and action. Define your target by opportunity and cash flow. Get upstream with brokers and bankers. Evaluate opportunities through strategic frameworks. Make offers on businesses that match your criteria. Conduct thorough due diligence, and transition successfully into the CEO role. The spiritual integration. When you own a company, something profound happens. Your company becomes an extension of you. It engulfs your spirit, mind, and body. When you breathe your company. When your company thrives, you thrive. This is different from employment, where there's separation between work and life. As an entrepreneur, there is no separation. Your work is your life's work. The mission is the same. The time is the same. For a true entrepreneur, financial independence is reached the moment they take ownership of a company or idea, because working hard for something you care deeply about becomes the life worth living. Perhaps this is the real wealth we all want, the purpose that comes with creating value in your life. Most entrepreneurs are highly achievement-oriented, which is one of Martin Seligman's 5 pillars of well-being: PERMA, positive emotion, engagement, relationships, meaning, achievement. Owning a business provides an unparalleled vehicle for achievement and engagement. The acquisition entrepreneur's advantage. You have advantages that didn't exist a generation ago. Information access. Everything you need to learn about business strategy, financial analysis, negotiation, and operations is available. This book provides the framework specifically for acquisition entrepreneurship. Financing availability. SBA loans make it possible to acquire businesses with as little as 10% down. Banks will lend because they can use business assets as collateral. Search funds and angel investors are increasingly interested in backing acquisition entrepreneurs. Network effects, online communities, mastermind groups, and organizations like the Entrepreneurs Organization provide support systems that didn't exist before. You're not alone in this journey. Market inefficiency. The private business market remains fragmented with huge variances in quality. This creates opportunity for prepared, intelligent buyers to find exceptional deals. Strategic advantage. You can bring innovation to established businesses. You combine the infrastructure of existing companies with entrepreneurial drive and fresh perspectives. This is more powerful than either startups or stagnant businesses alone. What success looks like. Let's paint a picture of what success as an acquisition entrepreneur might look like for you. Within 6 to 9 months from today, you're the CEO of a profitable company generating over $1 million in revenue. You have customers who value what you provide. You have employees who depend on you and contribute to the mission. You have real assets and infrastructure. You didn't spend years in the startup wilderness burning through savings and sanity. You didn't dilute your ownership by giving away equity to investors. You invested less than $100,000 and own 100% of a real company. You're earning a comfortable salary from day one while the business cash flow also services your acquisition debt. You've identified the key growth opportunity and you're implementing your plan. Your strengths are being applied exactly where they create the most value. Over the next 3 to 5 years, you grow the company 10% annually. Maybe you make strategic acquisitions to accelerate growth. You document processes, build systems, and develop your team. The company becomes more valuable and less dependent on you personally. After 5 years, your company has doubled in size. The bank loan is paid down or paid off. Your cash flowing $300,000 plus annually. You own an asset worth several $1,000,000 that you built from a stable platform. When you decide to exit, whether in 5 years or 25 years, you have options. You can sell to a strategic buyer, sell to a financial buyer, sell to your management team, or pass it to the next generation. The value you've built becomes realized capital you can deploy toward your next venture or your retirement. The cost of inaction. But let's also consider the cost of not pursuing this path. If you launch a startup instead, you face 90% plus odds of complete failure. Even if you succeed, you'll spend years building infrastructure with no guarantee of reaching profitability. You'll likely dilute your ownership significantly through fundraising rounds. If you stay in traditional employment, you're subject to corporate politics, limited upside potential, and the vulnerability of someone else controlling your income and career trajectory. Since 2000, job growth hasn't kept pace with population growth. Traditional employment is becoming less reliable. If you wait for the perfect time or the perfect opportunity, you'll join the masses who never execute. The best buyers know that getting upstream and seeing deal flow is how you find great opportunities. The learning curve. Will you make mistakes? Absolutely. Every entrepreneur does. But that's exactly why starting with an established business is so powerful. You have a margin of safety. The business already works. It has customers who keep buying. It generates cash flow every month. Your mistakes will be learning opportunities, not existential threats to survival. You can experiment, test, and innovate from a position of stability rather than desperation. The first 90 days will be intense as you learn the business and establish yourself as CEO. You'll face challenges you didn't anticipate. But you'll also discover opportunities you couldn't have seen from the outside. By the end of year 1, you'll have an intimate understanding of your business that rivals or exceeds the previous owners. You'll have implemented improvements and seen results. You'll have navigated challenges and built confidence. This is the learning curve of entrepreneurship compressed and accelerated by starting with infrastructure rather than starting from zero. Your next steps. If this approach resonates with you, here are your concrete next steps. This week. Complete your personal assessment, attitude, growth mindset, aptitude, strengths and weaknesses, and action what you want to do daily. Calculate what size business you can afford based on available capital. Draft your initial target statement. This month. Create your personal balance sheet and update your resume. Begin networking to identify business brokers, M&A advisors, and SBA lenders in your area. Schedule initial meetings with at least 3 to 5 brokers and 2 to 3 banks. Start reviewing online listings to familiarize yourself with what's available, but don't spend more than 2 hours weekly on this. Join online communities of acquisition entrepreneurs. Within 90 days. Complete meetings with brokers and bankers, getting on email lists for new listings. Refine your target statement based on feedback and opportunities you've seen. Identify 2 to 3 favorite brokers who understand what you're looking for. Get pre-qualified for financing with at least one bank. Have your CPA and lawyer identified and initial conversations completed. Request offering memorandums on 3 to 5 businesses that match your criteria. Within 6 months. Submit your first letter of intent. Begin due diligence on your target acquisition. Finalize financing. Close on your first acquisition. This timeline is aggressive but completely achievable for someone who commits to the process. Many acquisition entrepreneurs take longer because they're not committed, they don't know what they're looking for, or they get paralyzed by analysis. You now have the knowledge and framework to avoid those pitfalls. The entrepreneurship hack. Acquisition entrepreneurship is truly the startup hack, the shortest path to the desired destination. It's not a shortcut that compromises results. It's an optimized path that eliminates unnecessary risk while preserving all the upside potential. You get to be an entrepreneur without the brutal startup phase. You get to be a CEO from day one. You get to build value from a stable platform. You get to own 100% of your company. You get to apply your strengths exactly where they matter most. This is why Harvard, Stanford, Northwestern, University of Chicago, and other top business schools have developed programs specifically teaching acquisition entrepreneurship. The institutional recognition is beginning, but you don't need to wait for an MBA program to get started. Everything you need to know is in this book and the broader ecosystem of resources now available to acquisition entrepreneurs. The businesses are out there. The financing is available. The support network exists. What's required is your commitment and courage to take the first step. A life of passion awaits. Walker wrote this book not because he wanted to, but because he had to. The advantages of adding acquisition to entrepreneurship are so significant that this knowledge needed to be shared. The traditional entrepreneurship narrative celebrates grinding through uncertainty, overcoming impossible odds, and persevering through years of losses before maybe achieving success. That narrative creates hero stories but terrible statistics. The acquisition entrepreneurship narrative celebrates intelligent strategy, calculated risk-taking, and engineering success from the beginning. It's less dramatic but far more effective. When you adopt the acquisition entrepreneurship philosophy and by then build rather than start from scratch, you're able to begin with a profitable infrastructure and grow from there. There are no limits to what you can achieve. You've just optimized the starting point. Most importantly, you get to live the engaged life of an entrepreneur immediately. You don't have to wait until your startup reaches profitability, if it ever does. You don't have to delay gratification for years. The autonomy, the problem-solving, the growth, the passion, it's all available from day one. A spiritual integration occurs between you and your business that leads to the most engaged life imaginable. This is the promise of entrepreneurship, and acquisition entrepreneurship delivers it faster and more reliably than any other path. Final thoughts. The entrepreneurship economy is here. Owning your own business is not only the best path to building real wealth, it's increasingly necessary in a world where traditional employment provides less security and opportunity. The question isn't whether entrepreneurship is right for you. If you've listened to this entire summary, you already know it is. The question is which path you'll take. The startup path offers glory but brutal odds. The acquisition path offers stability and success from day one, with all the same potential for growth and value creation. You now have the blueprint. You understand the opportunity. You know the process. You have the framework for evaluation, negotiation, and transition. What you do next is up to you. Walker's final encouragement is this: if this book has made you aware of the opportunity, helped you see with more clarity, or inspired you to take the first step toward a life of acquisition entrepreneurship, then it has done its job. A life of passion awaits you. The infrastructure built by previous generations is available for you to acquire and build upon. The financing mechanisms exist to make it affordable. The market conditions are more favorable than they've ever been. Don't wait for the perfect moment. Don't wait until you know everything. Don't wait until the fear disappears. The perfect moment is now. You'll learn by doing. The fear never completely goes away. You just learn to act despite it. 6 to 9 months from now, you could be the CEO of your own profitable, established company. You could be living the engaged life of entrepreneurship. You could be building value and creating impact on your own terms. The only question that remains is, will you take the first step? Thank you for listening to this summary of By Then Build by Walker Deibel. For more resources, templates, and community support, visit bythenbuild.com. Now go out there and buy, then build, the business and life you've always wanted.